Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Welcome to a brand new week, and I would say it's a very interesting week going forward given the price action that we are seeing right now and 2 weeks ago. So before we start our gist of today's Daily Dose, very good morning for those who have just joined us. Today will be Monday, the 7th of April 2025. So let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap. What are the important news flow? Economic data release that has been released so far over the weekend, last Friday and today's early Asia session, as well as the impact on the movement of the broad-based cross asset classes. So we know that last week is being taken center stage by a negative feedback loop on the trade tariffs agenda up from US, indicating potentially we may start to see a start of a global trade war after that rather aggressive reciprocal tariffs hitting on US, we call it adversaries, and as well as airlines over here. So the stock market doesn't, we call it, react positively to that. So I could see on Friday, across the board sell-off continues on the major US stock indices that came in within our expectation. The SPX is down by -6%. The Nasdaq is down by -6% as well. The Dow Jones and the Russell 2000 at a smaller degree down by -5%, and the Russell 2000 down by -4.4%. So I could see on the heat map of the S&P 500 is over here is across the board. Okay, entire sea of red. Even the defensive, we call it sectors like the consumer discretionary, it's like the consumer staples, and as well as utilities, certain portion of the healthcare, neither of them managed to close in the green. All right, so what we could see over here is that the market right now is undergoing a kind of a systematic risk correction, which I did highlighted at the start of my daily dose last week and even earlier the week before, saying that whatever corrective rebound that we see on the US major stock indices are more corrective in nature. That means, i.e., they can bounce within a medium-term downtrend that is still intact. So what you could see over here is that this is the cash stock market performance of the major US stock indices on last Friday. All right, over here. Okay, so what you could see, this is the okay, 1 second, let me put it in log. All right, so this particular movement over here, right, this is the Nasdaq 100. Why I'm using Nasdaq 100? Because Nasdaq 100 is a leading US stock, major stock indices, and as well as the leading major stock indices in the rest of the world, given that in the last 10 years is the best performing index. So if the best performing index starts to shape a breakdown, that could imply further major risk off in the major US stock indices, and it could translate to also a negative feedback loop into the entire global stock market. So as we are speaking right now, the Nasdaq 100 is actually now trading down during the Asia session. It's about 16,500 level mark. So 560, 570, if you look at our OANDA CFD platform, this index, this level here, okay, in fact, let me put it. Okay, let me put it in writing. Okay, 6,570. Then you have this 15,795. Okay. Okay, these are very two important levels. One is the former major swing high of 22nd of November 2021 high, before that multi-month corrective take shape to hit a low of 13th of October 2022 low. So this crash or this multi-month corrective decline has been taken shape due to stagflation fears at that point in time, due to supply chain shock reinforced by the Russia and Ukraine war at that point in time. Price action managed to break through on the January 2024. Then right now it it's now shaping a major pullback support level as well, because right now it's testing around this level, okay, in today's Asia session, when the futures actually plummeted over here. All right, but this is the cash market I'm actually referring to. So later I'll flash on the intraday technical outlook using our CFD index. Is in fact somewhere around this level as we are speaking. Right, so if you look at the CFD index over here very quickly, right, let me showcase to you guys. All right, it's actually this level, 6,590, the low. Okay, the low so far 6,590, 335, right, managed to bounce and now trading at 16,724. All right, over here. So if you look back at the cash index, 16,724, okay, roughly this area here, it tested this morning. So the next level to watch out for will be at this 15,795, which is the another significant former major swing high, now turns the pullback support of 24th July 2023. And this level is very important because if you put it in log chart, in logarithm, because of the way the price action move is rather steep, is actually the long-term circular ascending trend line taken from the low of November 2008. All right, so this is the trend line that has been supporting this ongoing longer term circular uptrending phase, or the bullish phase of the Nasdaq 100 since November 2008 low. All right, since 2008 low. So this November 2008 low over here is the start of the capitulation that has been taking shape in the GFC, the Great Financial Crisis of 2000, we call it 2008, and that formed a capitulation low and kickstart this ongoing longer term circular bullish uptrend phase. So if we start to see a weekly close below 15,795 on the Nasdaq 100, that means we may install for not even a multi-month corrective bearish phase. It could last for at least a year, or even a longer, if that's the case, because based from a sentiment perspective, why it's broken down below more than 20 years of bullish uptrend phase that has been instilled in place since November 2008 low. So something to take a look out for this week. These are the two key levels to watch out. So later I'll cover what are the short-term technical levels to watch out for on the Nasdaq 100. All right, and if you look at the another news flow that is more pertaining to the market is economic data. On Friday, especially the non-farm payroll data came in more than expected. Market is expecting 135k job added. It added in more than what has market is expecting. But don't forget, jobs data are more lagging in nature. So we know that there are some leading US economic indicator has started to show signs of either stagflation and even recession, like the Michigan Conference Board Consumer Sentiment data. We have another soft data which is based on survey base, which is the ISM services, PMI, ISM services manufacturing, all showing that input cost has been increasing. So yes, despite the fact that non-farm payroll data has managed to shape better than expected, that actually causes the US dollar to actually bounce as well on last Friday. So that also came in within our expectation, because we expect the dollar to actually shape a intraday bullish reversal on last Friday against the euro, against the sterling, and also against the Aussie. So like as explained as well, is that the Aussie dollar remains the weakest against the dollar. So this is the dollar Aussie. That means $1 equals to how many Aussie? Why? Because the Australia dollar is considered as a risk on proxy currency. That means high beta currency. So if there's any scenario of a global risk off scenario arising from global stock indices, that means global stock indices sell off, the Aussie dollar more or less will actually move in direct correlation with the weakness on the global equity space as well. So that's why this explains why the dollar is the strongest against the Aussie on last Friday. All right, and also based on this short-term 5-day rolling performance basis. And what's interesting over here is that previously the risk of we tend to see leading elements on the FX market. That means the dollar will tends to weaken against the yen and the Swiss franc. That means the yen and the Swiss franc will tends to benefit in terms of risk off scenario. But however, we know that price action don't go vertical down and vertical up. They oscillate between trends. On last Friday, we do highlight there could be a bounce on the dollar yen, despite the fact that it's still the medium term downtrend is still down. So on the intraday basis, it's now doing that so-called dead cat and corrective bounce. What are the key levels to watch on the dollar yen, which indeed managed to hold in our short-term pivotal support that we had on last Friday? Do stay online, because I'll be covering the short-term intraday very shortly on the dollar yen. All right. So another movement we're going to share with you is the stagflation risk is pretty real, because Fed Chair Powell actually speech, he made a public speech. He spoke on last Friday, right after 2 hours later after the release of the non-farm payroll data, signal that the Fed is still on hold, wary of persistent price shock. That means he is pretty much concerned that stagflation risk is pretty much increasing in terms of probability. That means, yes, despite the fact that the stock market is falling, the Fed is in no hurry to actually ignite interest rate cut to actually so-called stabilize the negative feedback loop that is being seen on the stock market, and even some of the key economic data is flashing signs of recession. All right, but what's interesting over here is that the interest rate futures market, that means i.e. the Fed funds futures market, the short-term US interest rate futures market, does not believe the Fed may be on hold for too long for this year. So I would say it's rather aggressive or dovish kind of pricing. Yes, the next upcoming meeting, which is 7th of May, 2025, market is now reducing for a 50% chance that it may either hold or cut rates. So previously, right, the current rate is at 4.25% to 4.5%. They maintained on hold in the previous meeting. So previously, market has a very high chance of 81% chance they're looking at the Fed to maintain at 4.25 to 4.5%. But as we are speaking right now, this high odds of 81% has been reduced to 49%. So now it's like a toss of a coin, stating there could be a probability that the Fed may start to high. There is an increase in probability that the Fed, a 51% chance that the Fed may cut in the 7th of May meeting. Previously, it was very high of standing pat no cut at 81% chance, which is at 4.25%. So right now, there's a 50% chance that the Fed may move very fast on the next meeting on 7th of May, which is 1 month from now. But if you look, but the Fed Chair Powell has already give a signal stating that he may wait and see first. So the Fed funds rate seems to be pricing in a rather aggressive approach instead. And if you look at the way how it's being priced right now, so they're looking at for potential 50% chance of a 54% chance, which is close to 50% chance of a cut coming in the 7th of May meeting to reduce it to 4%, and another cut which is quite high at 77% chance to reduce it to 3.75% on the 18th of June meeting, and another cut of 80% chance on the 30th of June FOMC meeting, the 30th of July, pardon me. All right. And this one 56% chance, 17th of September. And you have a 65% chance that the Fed funds rate will be at 3% to 3.25% on the last meeting of this year, which is 10th of December 2025. 10th of December 2025. So what we could see over here is that market is now looking for potentially what 5 cuts, okay, because right now the rates is at 4.25%. So to bring it down to 3%, that means there is a 1.25% a cut. So 1.25% cut is equivalent to around 25 basis point. Let's say if the Fed cut 25 basis point cut each, so that could give rise to at least a 5 interest rate cut potentially that is being priced into the market right now. So I would say that it's a rather aggressive pricing by the market, and this thing could starts to change again as we start to see more Federal Reserve officials speaking this coming week, which I will also highlight in the daily dose as we move as we go on into as we progress into this week. All right, over here. Right, so it's a rather kind of a very aggressive market pricing stance right now by the Fed funds futures, as being compiled by the US CME Fed Watch 2, stating that market is now looking for potential 5 interest rate cut of 25 basis point each, because market is looking at a high chance of 66% that the Fed funds rate will end at 3% to 3.25%, and that's 1.25% down from the current rate of 4.25% to 4.5%. So it's a rather aggressive cutting in nature. So the key thing is market is now looking at a risk of a recession in first step rather than stagflation. Because in stagflation, we're talking about more of a slowdown in growth coupled with sticky inflation that prevent the Fed from cutting too aggressively. Right. So another particular news flow is China on Monday, as reported by their local media over here, which is the People's Daily. So it's a flagship newspaper of the Communist Party, stating there's still room for further liquidity accommodation, liquidity monetary policy cuts. That means, i.e., they are floating the idea or floating the stances of more aggressive monetary policy going forward, and as stimulus to counter the reciprocal trade tariffs that total right now, after that 34% that's being floated by Trump administration on last Wednesday, in addition to the 20% that is still in place. So China now faces a rather high tariff of 54%, much more against the tariffs that's been in place since trade tariff war one. All right, the trade war one that was in 2018 over here. All right. So, and don't forget, China also counter at with US another 34% tariff on last Friday. So that actually also exacerbate the major sell-off that has taken shape in the global stock market as we are speaking right now. All right, so that is the key news flow that has impacted the market over here. And what we could see over here is that even gold price, very interestingly, starts to fall and break below that 30,060. So gold market seems to be facing a rather repositioning of the markets over here, caused by a switch to actually park money into US Treasury over here. So what do I mean by US Treasury has been gaining? Because if you could see over here is that the price of the US Treasury yield is actually plunging right now. This is a 10-year yield. So a plunge in 10-year Treasury yield actually increase the price of bond. Okay, the price of bond, yield and bond are inversely related. So there is actually a speculative repositioning adjustment that causes the gold price to actually consolidate right now. This later I'll touch on. So it seems to us that the technical configuration of gold is now overriding the fundamentals of gold. That means by right, if the 10-year Treasury is slipping downwards, lower cost of opportunity of holding gold. So gold price should actually skyrocket to fresh all-time high. But why gold price can't skyrocket to fresh all-time high? Despite the fact that stagflation fears are getting more and more real in the global economy and the US economy, because of technical positioning factor, because the price of gold may have moved ahead of itself and starts to price in this stagflation risk. So once stagflation risk is getting more real, potentially short-term speculator may unwind their earlier long position. That causes the gold price to actually plummet, where stop loss prices got hit on the very short-term basis, and we start to see this kind of consolidation in gold price, where much earlier rally has already priced in this stagflation risk, where right now the reality is getting more and more real. So markets tends to be a bit of forward looking. So the prices, I want to explain to you all that why gold price actually fall on last Friday is more driven by positioning and technical factors rather than fundamental. So later I'll touch on more of the technical chart of gold and explain to you all why there's this correction movement that is going on. All right, over here. So with that, now let me now immediately touch on the second segment of today's daily dose, which is the fundamental and intermarket dynamics. So a lot of us pretty much concerns that given that the US market has fallen by a fair bit. So if you look at the Nasdaq 100 chart over here, all right. So since it's all-time high, okay, recorded in 18th of February at 2,222. Okay, very interesting number. 4 2, sir. 2222222. All right. One, yeah. 52, so I would say 22,222. That's the current, that's the fresh all-time high over here. Let me put it over here. Okay, this guy, very interesting number. Okay, 52s are 22222. Mark plummet by 21%. All right, so previously every 21% chance plummet correction. If you look back at some statistics, they may say that this could be a meaningful medium-term bottom that could be formed. So to answer this question, a lot of people may say that, hey, this might be the bottom where market may start to rally to fresh all-time high again. So to understand, to answer this question, we need to look at other factors at play rather than just the pure price action stating that, oh yeah, we now start to see a 21% plunge in the Nasdaq 100 based on some backward testing. After 21% plunge chance, 2 week down the road, 3 week down the road, even 6 months down the road, the Nasdaq 100 may be positive going forward. That means this could be a meaningful bottoming signs on the Nasdaq 100, indirectly stating that this could be a medium term or major low on the major US stock indices that the market could rally going forward in this year to do fresh all-time high again. So to answer that question, we need to understand other dynamics that is at play, which is intermarket dynamics at play. So I want to share with you all this particular chart over here. So this is the Dow Jones Industrial Average. The top will be the S&P 500. All right, the top S&P 500, and this is the ratio chart over here. Okay, let me put it, okay, so you guys could see. All right, so this is the Dow Jones. Okay, this is the S&P. Oops, let me put it in writing. Okay, it's a bit hang. I don't know why. Okay, hopefully my chart. Okay, let for a few seconds. Okay, good. S&P 500. Okay, so what I'm presenting to you is an intermarket dynamics, trying to decipher whether, okay, this is not S&P, but this is the, what I'm talking about. This is the Nasdaq. Okay, my apologies. Okay, this is the Nasdaq 100. Okay, all these are the cash market. That means it's not the futures market or the CFD market, taking into account of the last Friday price action. All right, because I want to actually give you guys in correlation with the key exchange traded fund. All right, so we know that the this current major uptrend phase that has been taking shape since September 2022 low has been led by this ratio chart of the momentum ETF. That means S&P 500 momentum ETF versus the S&P 500 ETF in terms of the ratio. That means if this ratio line is going up, that means momentum factor is having a outperformance against the S&P 500. So this last major trend since September 2022 low has been led by momentum factor of the S&P 500. All right, so basically this momentum ETF of the S&P 500, they didn't change the component of the S&P 500. They just reweight it according to the momentum factor. That means component stocks that has a higher momentum factor. Momentum factor, it can be driven by calculating rate of returns, weighted rate of returns by different time period, and you have a weighted average. Those weighted average momentum reading stocks, component stock that has a higher weight, like Nvidia will be one of them, the mega cap technology stock will be one of them, and even some of the banks. So this momentum, they will re-rate it according to the momentum factor. That means those S&P 500 stock that has a higher momentum reading will be rated at the top. All right, so this momentum factor is been leading this major uptrend phase of the Nasdaq 100, even the Dow Jones Industrial Average, despite the fact that the Dow Jones Industrial Average doesn't have significant component stocks in the mega cap technology stocks, because Nvidia is not the top 10, even the top 5, top 10 weightage in the Dow Jones Industrial Average. So I'm going to express to you that even though the Dow Jones Industrial Average doesn't have a very strong weighting in momentum factor, but if the momentum factor starts to do a significant breakdown, it could have a significant impact loop even into the Dow Jones Industrial Average as well, despite the fact that the Dow Jones Industrial Average has lower significant weighting in momentum play, i.e. the mega cap technology stocks. That means i.e. nowhere to hide, okay, once a systematic correction takes place, okay, throughout the US market. Is what I'm trying to express. So if you look at the momentum reading over here, what's interesting is that if I were to draw the major trend line, the ratio, this is the ratio chart. Oops. Okay, let me expand the screen so that you guys could see. Okay, yes, broken down below this parallel major ascending trend line. All right, over here. So indicating right now that the momentum factor is shaping a major breakdown. And how low can it go? The next major support level will be this former breakout line over here. Okay, previously minor swing high, like a base breakout now turns into a significant pullback support. All right, so what it means that the momentum factor still has much more unwinding to go before hitting a major support level at 0.15 based on its ratio chart or the relative strength chart against the S&P momentum ETF divided by the S&P 500. All right, and also because of momentum factor is unwinding very fast, the value factor of the S&P 500 ETF, that means right now value stocks inside the component stocks of the S&P 500, that means what the ETF manager do, or what does this ETF does is it re-rank the S&P 500 component stocks according to value factor. That means those has a higher value factor, like based on a debt ratio, lower debt ratio, we rank at the top. So but it doesn't mean that all these value stocks will starts to rise. It means that in terms of systematic risk or systematic correction phase taking place, value stocks will also fall in line with momentum stocks, but they fall at a lower rate or lesser momentum. So because it fall at a lower rate and lesser momentum, it managed to stage a bullish breakout from a former major descending trendline resistance that was in place since January 2023. So based on this intermarket relation over here, what I'm trying to share with you is that we know that the previous major uptrend phase from the September and October 2022 low of the Nasdaq 100 and even the Dow Jones Industrial Average, momentum factor now is greatly underperforming against the S&P 500. And it seems to us that there is still much more room to fall in terms of the underperformance towards 0.15 based on this ratio chart where I plot the S&P momentum ETF divided by the S&P, the normal S&P 500 ETF. That means despite the fact that the Nasdaq 100 has really fallen by 21%, yes, we know that in the past raw price action, 21% may see significant potential return going forward based on the 2-week or 3-week or 6-month ratio, whether we could plot it 6-week performance going forward based on past price action. But the intermarket dynamics based on sector rotation that I'm sharing with you, because momentum factor is weak, value factor starts to outperform the general market. That means, i.e., this ongoing 3 months plus of slide from the current all-time high on the S&P 500 and the Nasdaq 100 and even the Dow Jones and the Russell 2000 may not have seen a meaningful major bottom yet. That means, i.e., there could be still going forward multi-week to multi-months of weakness on the major US stock market. So this particular intermarket segment that I want to share with you, you guys, the crux of it is this. Right, so that ends the second segment of today's daily dose. So now let us move on to the intraday technical outlook on the major FX pair first. All right, which is the major dollar pair. All right, so without further ado, let me expand my screen so that you guys could have a better view of the charts. All right, over here. Okay, so with that, now let me share my screen over here. So let me do something first, but it seems to me that some of the screen is pretty much hang at the moment. So give me 1 minute, 1 minute, 1 minute. Just give me 1 minute. So I'll be back shortly. 1 minute over here. Okay, seems to be all right. So hopefully everything is back. Okay, the screen is moving. Okay, good. I think the screen is moving. All right. Okay, so let me touch on starting with the euro dollar first. All right. So the euro dollar, like we mentioned on Okay, hopefully it's, yeah, the screen should be okay. Yeah, should be okay. Got just like froze. Okay, the euro dollar last Friday we flipped to a bearish stance, looking for a intraday weakness on the euro dollar because there's some form of technical elements has started to turn weak after the overstretch rally on the intraday basis, hitting the long-term descending channel from January 2008 high, which is at 111.15. Market actually went down. The euro dollar went down and hit our support level at 1.0940 and almost hit the second support level at 1.0860, which is the 20-day moving average as well over here. So in today's Asia session, it managed to bounce slightly at the start of today's Asia session before collapsing again and forming a lower high over here. RSI still being kept below the 50 level mark over here, and by a descending trend line resistance as well, and hasn't hit the oversold region yet. So with this current short-term intraday technical element, momentum seems to be weak based on the hourly RSI, hasn't hit the oversold region. That means there could be still a persistence intraday bearish bias that may form on the euro dollar for today. So with that, we will be using a tighten short-term pivotal resistance for today at 110.80, which is so the minor the US session high upon the release of the non-farm payroll data. Can break out above it, and also right now close to this minor descending trend line that I drew from the high of 3rd of April as well. So using a tighten short-term pivotal resistance on the euro dollar for today 110.80, we will still maintain that intraday bearish bias on the euro dollar. First near-term support level to watch will be 1.0860. Breakdown below it exposes the next support level at 1.0770 slash 1.0730 will also correspond to the 200-day moving average. Only a breakout above an hourly close above 1.1080 will invalidate today's intraday bearish bias to see a retest at this 1.1150. A breakout above 1.1150 may see the continuation of the bullish movement on the euro dollar to expose 1.12 figure level, 1.122, 1.1220 next. Okay, so that's for the euro dollar intraday technical outlook. Up next will be the sterling dollar, or the sterling pound, we call it. The sterling dollar also plummeted as expected, broke below our support level, which is the 20-day moving average at 1.2965, and plummeted lower and almost hit the secondary support at 1.28 figure level, which is our 200-day moving average, I think, as a support level. So what I could see over here is that the RSI already hit the oversold region over here. Okay, but there is no clear, oops, but there is no clear form of bearish divergence or bullish divergence, pardon me. So there's no bullish divergence yet being formed as price shape lower low, all right, on the RSI, but now it's trying to exit from the RSI. So potentially there could be some form of minor bounce taking shape as we head into today's European session. So I'll be using a very tight short-term pivotal resistance to watch this minor bounce, which is potentially a retest back to the 20-day moving average, and also this former minor range top now turns to a pull, previously broke out, turns into a pullback support, now broken, now turns back into a resistance again at 1.2965. So using a tighten short-term pivotal resistance level for today at 1.2965, which also correspond very closely to the 20-day moving average, I think, as a key intermediate resistance as well. As long as 1.2965 is not surpassed to the upside in any chance of a potential minor bounce as we head into the European session due to the exiting of the oversold condition on the RSI as we're speaking right now, we'll still maintain that intraday bearish bias on the sterling dollar. Thereafter, potentially it may revisit the 200-day moving average, which is the first support level to watch out for today at the 1.28 figure level. A breakdown below it exposes the next near-term support level at 1.2755 slash 1.2725, which is the upward sloping 50-day moving average as well, and as well as this medium-term ascending channel support from the low of 13th of January. Right, only hourly close and a breakout above 1.2965 level will invalidate today's intraday bearish bias to see a start of a potential minor recovery in first step on the sterling dollar, exposing the next near-term resistance zone at 130.10 slash 130.30. Above 130.30, revisit last Thursday swing high area at 1.2170 slash 1.3210 next. So that's for the sterling dollar. All right. Up next will be the Aussie dollar. So the Aussie dollar plummeted as expected, right? It broke below 61.40 over here, okay, and 60 level, 60.90. And right now, if we go to the daily time frame chart, it's actually testing the very important congestion area here of the March 2020 low, right? All this minor congestion here, the March 2020 low level, which is the March 2020 swing low area. Okay, all these are March 2020 swing low area that took shape during the pandemic situation at that point in time. Okay, March 2020 major swing low areas. Right. So with that, let's go to the hourly time frame chart again. So we know that price action, I explained to you guys that price action don't go vertical down and vertical up, they oscillate. So what we could see is that very steep sell-off phase on the Aussie dollar has starts to give rise to a major, not major, a bullish divergence condition as that's being flashed out on the hourly RSI. So indicating that potentially this down move here has really been overextended to the downside. And if we do the Fibo extension, okay, it's also the 0.382 Fibo extension as well. That means that means this is the wave 1, wave 2, wave 3, wave 4, wave 5, and ended with a very close to the 59.10 level, which is the low is 59.20. So give or take is very close to the 0.382 Fibo extension fifth wave target, ended with a bullish hammer formation in today's start of today's Asia session. Bullish divergence on the hourly RSI at its oversold region, so indicating that there could be a chance right now to do at least a retracement of this five wave down move that has been taking shape since last Thursday all the way to today's Asia session low. So with that, I will flip to a intraday bullish bias for today on the Aussie dollar using 59.20 as my short-term pivotal support level. Near-term resistance level to watch will be 6060/6090. A breakout above 6090 exposes 6140 next. So if we do the Fibo retracement of this ongoing five-wave down move or the minor decline phase that may have start to see a pause right now to see a form of a Fibo retracement in terms of the elliott wave perspective to do a ABC wave before another five-wave down move. So the 6140 also coincide with the 50% Fibo retracement as well. Right, only a push down and an hourly close below 59.20 will invalidate today's intraday bullish bias for that minor mean reversion rebound pace to take shape, and that will be invalidated to resume the impulsive downward sequence to expose the next near-term support level at 58.70 followed by 58.05 level. All right, over here. So i.e. in a nutshell, due to the latest technical configuration on the hourly RSI and the elliott wave perspective of a five-wave down move that have been complicated, formed by a bullish hammer candlestick at the start of today's Asia session, there could be a chance of a mean reversion rebound taking shape on the Aussie dollar after 2 days of steep sell-off. So using 59.20 as my short-term pivotal support, we'll flip to an intraday bullish bias for today on the Aussie dollar. Right, lastly will be the dollar yen. So dollar yen managed to stage that rebound. So still recall last Friday we turned bullish using 144.80 as my short-term pivotal support level. Price action almost hit the first support resistance at 47.60 before trading sideways. In today's last Asia session, it plummeted and now it starts to stage a rebound back again. So first support level to watch will be at this congestion area here, 154.80, but I don't put it so tight as my short-term pivotal support level. So the short-term pivotal support level is still at 144.80 because it managed to shape that intraday V-shaped movement after retesting it at the start of today's Asia session, and RSI still continue to shape a series of higher low and haven't hit a overbought region yet. So with that, we'll still maintain the intraday bullish bias for the extension of this ongoing mean reversion rebound scenario that may still be in place for the dollar yen, using 144.80 as my short-term pivotal support. First resistance level to watch 147.60. Above it may see 148.15 coming next, and with that maximum 149.10, which is also correspond to the 20-day moving average, I think as the next intermediate resistance level as well. Only a push down and an hourly close below this 144.80 will invalidate today's intraday bullish bias to kickstart another round of impulsive down move to expose the next support level at 143.90/60 in the first step. All right. So i.e. in a nutshell, still using 144.80 short-term pivotal support on the dollar yen to maintain this ongoing mean reversion rebound scenario that may still have some legs to go on the dollar yen FX rate. So with that, that also sum up the intraday technical outlook on the major dollar pair. So let us now turn our attention to the towards the major stock indices. All right, starting with the Hong Kong 33. All right, so the Hong Kong 33 last Friday we were neutral. Then between 22,500, no conviction to maintain that bullish bias. Price action indeed gap down today because last Friday there was the Hong Kong stock market was closed for a public holiday. So with this gap down over here, there's actually a big risk right now that it may start to shape a multi-week corrective decline after breaking down below the 50-day moving average very clearly. So using 21,300 level as my short-term pivotal resistance level for today, which is also the former minor swing low of 11 of February. And if we do the Fibo retracement of this ongoing sell-off from the high of 27 of May all the way to the current intraday low here, okay, current row that's so very close to the 23.6% Fibo retracement. All right, so as long as 21,300 short-term pivotal resistance holds on the Hong Kong 33, we will maintain that intraday. We will flip to an intraday bearish bias on the Hong Kong 33. Next near-term support level to watch will be 19,880/75, which is pretty important, but that's coincide with the 200-day moving average. A breakdown below it exposes 19,385 next for today. And if this 19,385 can't hold, it will expose 18,955. So 18,955 is very important because if we go to the daily time frame chart, 18,955, right, it corresponds to the major ascending channel support from the low of January 2024. Right, only a price action breakout and hourly close above 21,300 short-term pivotal resistance that will invalidate today's intraday bearish bias. I'll begin a breakout in the hourly close above 21,300 short-term pivotal resistance level on the Hong Kong 33 representing the Hang Seng Index that will invalidate today's intraday bearish bias to kickstart a minor mean reversion rebound to cover the gap, the significant gap down, exposing the next near-term resistance level at 22,740 and even 22,180 next. All right, so that scenario, if I do the Fibo retracement, that coincide with a bunch of Fibo ratio as well, which is the 50% Fibo ratio, 61.8%, and the 38.2% Fibonacci ratio. All right, so i.e. in a nutshell, flipping to an intraday bearish bias on the Hong Kong 33 using 21,300 as my short-term pivotal resistance level. Up next will be the Japan 225. So the Japan 225, previously we wanted to look out for a mean reversion rebound, but the mean reversion rebound didn't take shape at the 33,360 level and it plummeted all the way down. And right now, it almost hit the August lower. So what you can see right now is that the Japan 225 now has tested the last year August low sell off, right, before staging a bounce, right, over here at 5th of August, right, the August low. So but if you look at the hourly time frame chart on the hourly RSI, there is no form of any signs of exhaustion on the down move. That means i.e. the hourly RSI is still going to shape a lower low. There is no bullish divergence on the hourly RSI. I mean, there's no bullish divergence on the RSI. That means downside momentum has not to ease off. So what I want to do over here is that yes, there could be some kind of bounce. So as long as this bounce didn't surpass a very tightened short-term pivotal resistance here, which is the 38% Fibo retracement of this ongoing sell-off from the high of last Thursday all the way to today's Asia session low, 32,600/32,860, we'll be using as a short-term pivotal resistance zone to flip back to a intraday bearish bias on the Japan 225. A breakdown below 30,390 exposes the next near-term support level at 29,295/28,960. Below it sees 28,270 next. Only an hourly close above 32,860 will invalidate today's intraday bearish bias to kickstart a mean reversion rebound scenario, exposing the next near-term resistance level at 33,360, followed by 34,080, which is the 50% Fibo retracement and the 61.8% Fibo retracement as well over here. Next up will be the German 30. So the German 30 over here also plummeted, didn't manage to shape that mean reversion rebound at the 21,100 level and appears all the way down. So with that, now it's testing the 200-day moving average over here. So potentially there could be some sign of a minor bounce taking shape to cover the gap down that we see so far in today's Asia session at 23,390/440. I use a slightly higher level, this meeting line over here at 20,720, which is also the Fibo retracement, okay, of 38.2%, right over here. So using 20,720 short-term pivotal resistance level for the Germany 30 represent the German DAX. So we'll flip to an intraday bearish bias on the Germany 30 over here. A breakdown below 19,680 may expose the next near-term support level at 18,935, which is a 2.618 Fibo extension. Only an hourly close above 20,720 will invalidate today's intraday bearish bias to see the start of a mean reversion rebound, at least to see some form of a retracement to expose the next near-term resistance level at 21,100, followed by 21,310, maximum 21,540, which is the former minor descending channel resistance breakdown now turns into a pullback resistance level. So i.e. flipping to an intraday bearish bias using 20,720 as my short-term pivotal resistance on the German 30. Up next will be the major US stock indices, starting with the US Wall Street 30. So the Wall Street also plummeted and went down below our support level at 39,130 that we highlighted on last Friday. So right now it hit the 3.618 Fibo extension before shaping a kind of a minor bounce. RSI extreme oversold, but there's no bullish divergence as well, as it's going to print a lower low over here. So any form there could be there could be a potential bounce towards at the start of the US session to cover this gap up. The gap down, I would say, to cover the gap down in today's Asia session, which is at 38,000 slash 38,250. So I will use the meeting line over here, all right, as my short-term pivotal resistance instead, just to prevent any whipsaw, given this kind of high volatile movement that we're seeing in the marketplace right now. 39,130 adjusted short-term pivotal resistance for today on the US Wall Street 30, maintaining that intraday bearish bias. The next support level to watch after 36,790 slash 36,400 will be 35,755, 35,460. Only an hourly close above 39,130 will invalidate today's intraday bearish bias to see the start of a mean reversion rebound taking shape on the US Wall Street 30, exposing the next near-term resistance level at 39,650 slash 870, followed by 40,440 next. All right, next up will be the Nasdaq 100. So the Nasdaq 100 managed to plummet below the 17,250 level as well that we highlighted on last Friday, came down and hit the 16,590 335 level, which is a major support that I highlighted earlier on the daily chart of on the weekly chart of the cash index. But however, the hourly chart is not flashing any bullish divergence. Price action the RSI continues to shape a lower low, but now it's already hitting a extreme oversold level on the hourly RSI. So there could be some form of a minor bounce taking shape on the Nasdaq 100 to actually cover today's gap down during the start of the Asia session at 17,250 will be the first resistance level to watch. But I use this meeting line here, a slightly higher level, 17,760 slash 17,880 as my short-term pivotal short-term pivotal resistance level for today. So adjusted short-term pivotal resistance level 17,760, 17,880 on the Nasdaq 100, maintaining that intraday bearish bias for it. Below 16,335 exposes 15,850 slash 770 next on the Nasdaq 100. Only an hourly close above 17,880 will invalidate today's intraday bearish bias to kickstart a mean reversion rebound scenario. For the next intermediate resistance to come in at 18,540 or 18,570, followed by 19,020, which is coming close to the 20-day moving average. I think as an intermediate resistance as well. So i.e. in a nutshell, using an adjusted short-term pivotal resistance level 17,760 slash 880 to maintain that intraday bearish bias on the Nasdaq 100. All right, so that sum up the intraday technical outlook on the major stock indices. So let us now move on to the commodities market, starting with gold XAU/USD. So the thing about gold XAU/USD I want to share with you all is this over here, because if you look at the weekly chart of gold, it hit the upper limit of this major ascending channel from the low of 19th of February 2024, and it starts to form a weekly bearish candlestick as well. So now there's a risk that the gold price itself has really accelerated on the upside, hitting the upper limit of this major ascending channel. And because of it has really moved ahead of itself and really starts to price in that stagflation risk scenario. So now stagflation risk scenario is getting more and more real. There could be potentially short-term speculator we call it off taking the earlier bullish position, and that may cause a multi-week corrective pullback to take shape, to mean revert back towards the lower limit of this channel again at 2008.30. It means there's an increased risk of that. And the first support level to watch definitely for sure will be at the 50-day moving average at around the 2,940 level. All right, so that's for the weekly chart. So given that the weekly chart is not so rosy right now, to continue the impulsive upmove sequence to flash another fresh all-time high pretty soon. So on the intraday basis, for today, we will actually now flip to a neutrality stance instead. All right, so over here last Friday we're using 3060 as my short-term pivotal support to look it for the rebound. Yes, it rebound hitting 3,137 upon at the start of the European at 7 p.m. Singapore time. Then thereafter it plummeted all the way, so it can't break above our first resistance, so that represents sign of weakness. So with that, it play around the 2,980 level, the next support level for today. So with that over here is that it managed to survive the 3,000 psychological level again, as it starts to shape that hourly bullish candle at the 9 a.m. mark. So it's a rather choppy price action that I'm seeing right now for gold XAU/USD. So with that, I will turn then where it reintegrate above that 3,000 level is because there's this major ascending channel that not major, minor ascending channel that I drew from the low of 30th of December. All right. I would say medium-term ascending channel that I drew from the low of 30th of December last year, where it reintegrate back above it. So given such choppy price movement over here, I don't want to turn outright bearish yet so far on gold XAU/USD. So for now, I will wait and observe. So I'll turn into a neutrality stance for gold right now, 3060/3000. Only an hourly close back below 3000 may expose the next near-term support level at 2,955, followed by 2,936, which is the congestion area here of 12th of March and 13th of March, which will correspond to the 50-day moving average, acting as a next support level or near-term support level to watch. All right, only an hourly close above 3060 will negate today's bearish bias to see another choppy up move to revisit 3,137 again in the first step. So given the rather choppy price movement of gold price right now, I will turn to a neutrality stance first between 3,060 and 3,000, but I'm watching the 3,000 level, and hourly close below it may expose the next near-term support level at 2,955, followed by 2,955, followed by 2,936 next. Okay, so that's for gold XAU/USD. Lastly will be the West Texas crude oil. So the West Texas crude oil plummeted as expected, broke below the 65.40 level and went all the way down to the low of 59.55 over here. All right, so what you could see over here is that there is a bullish divergence that has been taking shape right now as we are speaking, bullish divergence, so indicating there is some form of overextended decline that we see so far in West Texas crude oil. So for today, we will flip to an intraday bullish bias for this potential mean reversion rebound to take shape over here. So mean reversion rebound resistance level to watch will be the gap over here, the gap down that is seen today is today's Asia session 62.50 level. All right, and as well as slash the swing high of last Friday 63, so basically 62 50 slash 63.36. All right, so with that I'll be using 59.55 as my short-term pivotal support level because of this bullish divergence that's being seen on the hourly RSI, indicating that this downside momentum is overstretched. So there could be a chance of a mean reversion rebound taking shape. Mean reversion rebound, first resistance zone to watch 6250/6336. Above it may revisit 6540 next, which is the former major descending channel range support now turns into a major pullback resistance level. However, if price action continues to plummet with an hourly close below 59.55, then the impulsive down move may continue to expose the next near-term support level at 57.23/57.10 for West Texas oil. So that sum up the intraday technical outlook on the major broad-based stock indices. So what are the key data to look out for before we go for today? So for the key data to look out for this week, so today will be 7, this will be 7th of April. So during the European session, we have 5 p.m. Eurozone retail sales figure will be out that could impact the Germany 30 and the euro dollar pair. And thereafter, we have a ECB official speaking. ECB support loan will be at 5:45 p.m. And up next will be a Fed speak. So Federal Reserve official Fed Kugler will be speaking at 10:30 p.m. Singapore time over here. So with that, sum up today's Daily Dose of Market Insights. I'm Kelvin here, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you very much.